All right, welcome back to the deep dive. We all know you guys are busy out there, and we really appreciate you carving out some time to join us today.
Absolutely. Always a pleasure to be back.
So, you know how it is with a deep dive, right? We try to take these complex topics in finance and investing and break them down. We really want to get to that core understanding, and today's no different. We're diving deep into hedge fund allocation.
And we're not just talking about the basics here. You know, we're going beyond the typical labels and really examining the strategies. These are the kinds of insights that can give you an edge in this ever-changing investment world.
Exactly. So listeners, think of this as your express lane to understanding how the real players in the game, those institutional investors, are thinking about allocating to hedge funds. Especially in today's market, it's pretty tricky.
It really is.
Yeah.
The landscape has shifted so dramatically.
It really has. Gone are the days of, kind of predictable globalization, low inflation.
Steady interest rates.
Yeah, it felt like we were in this nice, calm period. And now...
Well, now it's a bit of a roller coaster.
Yeah.
Geopolitical tensions are flaring up. Inflation is stickier than anyone expected.
And interest rates are, well, they're on the move.
And we've got this great paper to guide us through this new reality.
That's right. It's called Building a Hedge Fund Allocation, integrating top-down and bottom-up perspectives. And it's a pretty recent one, published just this past June 2024.
Authored by some real experts in the field. You've got folks from GIC, a major sovereign wealth fund, and JP Morgan Asset Management.
Big names, so there's going to be some serious insights here.
For sure.
So what we really want to pull out of this paper today, what's our mission?
Our mission is to really grasp how these institutions are approaching hedge fund allocation in this new, let's be honest, more challenging investment environment. And as we said, we're going deeper than those surface-level strategy classifications. We're digging into the why behind their decisions.
Exactly. Because at the end of the day, knowing why is what gives you the power to make informed decisions for your own portfolio.
Right. And one of the first things the paper points out is that this new environment, well, it throws a wrench in those traditional asset allocation models. Those models that worked so well when things were more predictable. Not so much anymore.
Yeah, those playbooks are looking a little outdated these days.
A little bit. And that's where hedge funds come in. With their ability to go both long and short, they can profit whether markets are going up or down. That kind of flexibility is really appealing when the market gets volatile.
It's like having a secret weapon that can adapt to whatever the market throws at you.
Exactly. And when you think about it, it makes perfect sense. If the old, reliable ways of diversifying your portfolio are becoming less reliable, you need something that can handle those twists and turns.
And hedge funds have that potential.
Right. Now, this isn't to say that hedge funds are a magic bullet or anything, but they do offer a unique value proposition in this new landscape. And the paper breaks down what investors are really hoping to get from their hedge fund allocations.
They're looking for a few key things, aren't they?
Yes. First off, they want that low correlation to equities, meaning they don't want their hedge fund investments moving in lockstep with the stock market.
You want something that zigs when the market zags.
Right.
That classic diversification play.
That's it. And the paper actually backs this up with some data. They looked at performance from January 2011 to December 2023 and found that over half of hedge funds had a correlation of less than 0.5 with equities.
Okay, so that's pretty good evidence that hedge funds can offer some true diversification. But which strategies tend to excel at this?
The paper highlights managed futures, commodities, and macro strategies. These strategies often operate in markets that are less directly influenced by stock market movements, so their returns tend to behave differently.
Makes sense. So you've got that diversification angle covered. What's the second big thing investors are looking for?
It's all about capital preservation, especially during those dreaded equity market downturns.
Everyone hates seeing their portfolio in the red.
Absolutely, nobody enjoys that. And this is where hedge funds can potentially shine. According to the paper, during the 5 worst equity drawdowns between 2011 and 2023, the average hedge fund saw losses of around 7%.
7%. That's not insignificant, but...
But compare that to the MSCI World Index, which represents a broad swath of global stocks.
Yeah.
It plummeted by 18% during those same periods.
Wow. So hedge funds, on average, held up significantly better.
That's the idea. And here's another key point. The paper emphasizes that performance varied quite a bit across different hedge fund strategies. Managed futures and macro actually generated positive returns during some of those equity downturns.
Really, positive returns when the stock market is tanking.
Exactly. That's the kind of resilience that investors are looking for, and it speaks to the power of diversification within the hedge fund space itself.
So it's not just about diversifying away from stocks, it's about diversifying within your hedge fund allocation as well.
Absolutely. And the paper actually found that around 34% of hedge funds delivered positive returns in 2 or more of those 5 worst equity drawdowns.
That's a pretty strong argument for their potential as a capital preservation tool, especially compared to some traditional safe havens that haven't been so safe lately.
And you're right to bring that up, because we have to acknowledge the elephant in the room, or should I say, the bond in the room. For years, high-quality government bonds were the go-to for protecting capital during stock market sell-offs. But in this new environment of rising rates, not so much.
Yeah, we saw that play out in 2022, didn't we?
We did. Both stocks and bonds took a hit that year. It was a wake-up call for a lot of investors, because it demonstrated that those traditional relationships can break down.
So it's not just about cushioning the blow when equities fall. It's also about finding assets that can generate more consistent returns in a world where those old correlations are less reliable.
Absolutely. And that's a key takeaway from the paper. Hedge funds, in aggregate, delivered relatively stable returns with lower volatility during that same period.
Okay, so that's 2 boxes ticked.
Yeah.
Diversification and capital preservation. What about the big one, that elusive alpha?
Ah, yes, the holy grail of investing, outperforming the market. Well, the paper finds that on average, hedge funds delivered an annualized excess return of around 2.5% over cash plus equity beta. This was between 2011 and 2023.
So they did manage to generate some alpha.
On average, yes. But here's where it gets really interesting. The paper found that lower beta strategies tended to produce higher alpha. Beta, of course, measures a fund's sensitivity to the overall market. So a higher beta means a fund's returns are more closely tied to the ups and downs of the stock market.
So if you want that alpha, you might be better off looking at hedge fund strategies that are less correlated with the overall market.
That's what the paper suggests. Because just taking on more equity-like risk within a hedge fund doesn't necessarily translate to better performance.
Makes you think twice about simply chasing those high beta funds.
Exactly. Now, the paper also tackles this common misconception that just looking at traditional strategy classifications like equity long-short or global macro is enough to build an effective hedge fund allocation. And they argue pretty convincingly that it's not.
So you're saying that just because a fund says it's global macro doesn't mean it's automatically going to behave the way you expect.
Right. And this is where the paper gets really insightful. They propose moving beyond those standard labels and instead categorizing funds based on those 3 key attributes we've been discussing: their correlation to equities, their resilience in downturns, and their alpha generating potential.
So it's about the specific role a hedge fund plays in your overall portfolio strategy rather than just slapping a label on it.
Exactly. And they use this cool statistical technique called quantitative clustering to identify 4 distinct subgroups. They call them loss mitigation, equity diversifier, equity complement, and equity substitute.
So like a new taxonomy of hedge funds based on what they actually do, not just what they call themselves.
That's the idea. Think of it as a more practical way to classify hedge funds.
I like it. So what are these 4 subgroups all about?
Well, loss mitigation funds are the real stars in terms of defense. They aim for negative or very low correlation to equities and tend to actually perform well, even positively, when the market is stressed. And guess what? They often deliver the highest alpha.
So these are the ones you want to have in your bunker when the market throws a tantrum?
That's right. Then you have equity diversifiers. These also offer low correlation, but might experience small losses during a downturn. However, they still tend to deliver pretty high alpha.
So they're still playing that diversification role, but maybe not as strong on the capital preservation side?
Right. Then you have equity complement. These have a more moderate level of correlation and might experience moderate losses during a market stress, but they also tend to offer moderate alpha generation.
So they're kind of like the middle ground, offering some diversification and some alpha potential.
Exactly. And lastly, you have equity substitute funds. As you might guess, they tend to behave more like the broad stock market. Higher correlation, bigger losses during downturns, and typically the lowest alpha generation.
So in essence, they're kind of defeating the purpose of allocating to hedge funds in the first place.
If your main goals are diversification and alpha, then yes. Now, the paper presents some great visuals to illustrate how these subgroups stack up. Figure 7 in the paper really brings this to life. They show the average return during those big equity drawdowns, the annualized alpha, and the average equity correlation for each subgroup. And loss mitigation really stands out. Positive performance in those down markets, high alpha, low correlation.
It's like the all-star of hedge fund subgroups.
Pretty much. But here's the kicker, and this is what really drives the point home. These 4 subgroups, they're not just confined to specific traditional strategies. You can find all 4 of them within each of the traditional hedge fund categories. And that's what Figure 8 illustrates beautifully. Whether it's a macro fund, an equity fund, or a relative value fund, there could be individual funds that fit into any of these 4 role-based categories.
So it's really blowing up this idea that you can just lump hedge funds together based on their strategy label.
It's all about looking under the hood, right? Because what makes a hedge fund truly unique are the individual manager's decisions, their investment style, the specific assets they focus on, their risk tolerance. All of these things contribute to the fund's ultimate role in a portfolio.
And that's why this concept of role-based classification is so powerful.
And the data backs this up. The paper highlights that the performance within those traditional classifications, like macro or equity, can vary wildly. Like, we're talking double-digit percentage point differences during those worst market downturns. So the message is clear. Don't just rely on the label. You've got to dig deeper.
So you've convinced us that this role-based approach makes sense. But how do you actually put it into practice?
Right. Now comes the fun part. Building the actual portfolio. And the paper walks us through 2 scenarios. First, how to construct a standalone hedge fund allocation. And second, how to integrate hedge funds into a more traditional portfolio, like a 60-40 stock and bond mix.
So let's start with that standalone allocation. What's the key here?
The paper introduces this idea of the efficient frontier. Now, this might sound a little technical, but it's actually a very intuitive concept. It basically helps us visualize all the different possible portfolio combinations.
Okay.
And it shows us the sweet spot, that optimal balance between risk and potential return. And the portfolio on this efficient frontier that maximizes risk-adjusted returns, what we call the Sharpe ratio, well, it turns out to have a specific mix.
And that mix is?
It's 59% allocated to those loss mitigation funds, 19% to equity diversifiers, and 22% to equity complement funds.
Interesting. So even in a portfolio that's entirely made up of hedge funds, that diversification across those role-based subgroups is crucial.
It really is. Now, what's fascinating is that while a portfolio fully invested in equity substitute funds might have the highest potential return overall, it actually comes with the lowest Sharpe ratio.
Meaning you're not being properly compensated for the extra risk you're taking.
Exactly. So even in a pure hedge fund portfolio, spreading your bets across those different roles is key for optimizing your risk-reward profile.
Okay, that's standalone. What about when you're integrating hedge funds into a more traditional portfolio, like the classic 60-40?
That's where it gets even more interesting. The paper assumes a 20% allocation to hedge funds within a 60-40 portfolio. And they found that the best way to allocate that 20% is to go all in on loss mitigation funds.
Really? 100% loss mitigation. Why is that?
The logic is this. Those loss mitigation funds, with their negative or very low correlation to equities, they act as a much better diversifier for the overall portfolio than those traditional bonds in today's rising rate environment.
So you're using those loss mitigation funds to essentially replace some of that bond exposure.
That's the idea. By reducing the overall portfolio volatility through this enhanced diversification, you can then afford to increase your allocation to equities. So you get to maintain that equity exposure while potentially improving your overall returns without taking on more risk. Pretty neat, right?
Very cool. So it's a completely different way of thinking about how to use hedge funds in a portfolio.
Right. Standalone, you might be more focused on those higher beta funds, aiming for those absolute returns. But when you're integrating, it's all about using those diversifying funds to enhance the overall portfolio.
Makes perfect sense. And this also ties back to the idea that if you want that broad equity exposure, you're probably better off just investing directly in stocks.
Exactly. No need to complicate things. The paper also touches on an alternative to chasing higher returns by simply increasing your allocation to high beta funds.
Oh, I'm intrigued. What is it?
It's the idea of leveraging those diversifying funds. So instead of shifting toward managers with higher market sensitivity, you could amplify the returns of those lower correlated strategies through leverage.
So you get the diversification benefits and then use leverage to potentially boost those returns.
Precisely. Of course, this has to be done carefully with robust risk management. But it's an intriguing concept for achieving those higher risk-adjusted returns. And then there's portable alpha.
Oh, that's always a fun one to unpack.
Imagine finding this super talented hedge fund manager who consistently delivers returns that are uncorrelated with the market. That's the alpha. With portable alpha, you invest with that manager and then use separate financial instruments like futures to dial in your desired market exposure, or beta.
So it's like separating the source of your returns from your overall market exposure, right?
Exactly. It gives you that flexibility to tailor your portfolio more precisely.
Okay, so we've talked top-down portfolio construction. Now let's get into the nitty-gritty of picking the right managers. The paper really emphasizes this bottom-up approach.
It does, and for good reason. Due diligence is paramount here. You really have to understand how a particular manager generates the returns. What's their investment process? What's their edge? Because relying solely on past performance can be very misleading.
Yeah, the past doesn't always predict the future, especially in the world of hedge funds. The paper actually uses a really good example to illustrate this point. They talk about commodity trading advisors, or CTAs.
Right. Now, historically, some CTAs tended to be positioned for a falling interest rate environment. So some investors might have just assumed that they were inherently defensive. But guess what? In an environment of rising rates, that historical relationship might completely break down.
So you can't just assume that a certain strategy will always behave the same way.
Exactly. And that's why the paper provides this really helpful breakdown of factors to consider when you're evaluating equity long-short managers. Figure 14 in the paper lays this all out.
It's like a cheat sheet for finding those high-quality managers.
Pretty much, and walks you through all these different characteristics, from net market exposure to trading frequency to investment style.
So it helps you really pinpoint what makes a manager tick, what gives them that unique edge.
Exactly, because what you're looking for is a demonstrable, repeatable, and sustainable competitive advantage. Whether it's deep expertise in a specific sector or a proprietary trading algorithm, there has to be something that sets them apart.
And then when you're building a portfolio of multiple managers, it's not just about having different strategy labels, right? It's about finding managers who are truly complementary.
You got it. True diversification at the manager level, it's about finding managers whose returns don't move in lockstep. The paper breaks this down into 3 key areas. You want managers with relatively low correlations between their returns. You want to avoid managers who tend to experience drawdowns at the same time. And you want managers with truly differentiated approaches, whether it's their investment style, their geographical focus, or their time horizon. You want a mix of managers who aren't all making the same bets at the same time.
So you're spreading your risk across different styles, different markets, different ways of thinking.
That's the goal. Now, the paper also touches on an interesting aspect of manager selection: emerging managers.
Ah, yes. The up-and-comers.
They can offer some unique opportunities. They often have more specialized strategies, they're more nimble because they manage less money, and they might offer more favorable fees to early investors.
But there are also risks, right?
Of course. Less of a track record, potentially less developed infrastructure. It's a balancing act. The paper stresses that if you're going to invest in emerging managers, you need a clear plan for scaling up your allocation as they hit specific milestones.
So it's about taking calculated risks and being prepared for the fact that not every emerging manager is going to be a home run.
That's right. Now, once you've built your portfolio of managers, the work isn't over. Ongoing portfolio management is crucial.
Because markets change, managers evolve, new opportunities arise.
Exactly. It's a dynamic process. And the paper talks about how even though diversification is generally a good thing, there are diminishing returns. Beyond a certain number of managers, the added diversification benefits start to fade. And they mention the Monte Carlo simulations suggest that this point might be around 15 to 20 managers.
But of course, there are practical considerations that might lead you to have more managers than that.
Of course. Like if you're trying to access a very specific niche strategy, you might need to add more managers to your roster. The paper also talks about the tricky decision of when to fire a manager. If they're underperforming, it's tempting to just cut them loose.
Yeah, nobody likes seeing those red numbers in their portfolio.
But it's not always that simple. Because firing a manager means you lose out on any high water mark for performance fees. And you also have that opportunity cost of holding the recovered capital in cash while you're searching for a replacement.
So it's not just about getting rid of the underperformers. You have to consider the costs and the potential downsides of making that change.
Exactly. And this speaks to the need for really understanding a manager's investment process. You have to be able to differentiate between normal market volatility and a genuine deterioration in their approach.
So you don't want to overreact to short-term performance swings. You have to have conviction in your managers.
Right. Now, the paper also touches on the idea of making dynamic adjustments to your strategy allocations based on those bigger structural shifts in the market.
Like adjusting your portfolio to reflect the fact that we're now in a rising rate environment.
Precisely.
Yeah.
But they caution that timing these top-down shifts is incredibly difficult. And nobody has a crystal ball. And they actually suggest that the insights you glean from your bottom-up analysis of individual managers are often more reliable indicators of what's really going on in the market.
Because those managers are on the front lines seeing those shifts unfold in real time.
Exactly. And then, of course, there's the ongoing task of risk management.
Ah, yes, the not so glamorous but absolutely crucial part of managing a portfolio.
You said it. It's not enough to just assess the individual risks of each manager. You have to look at the big picture. What's the overall portfolio exposure to various market factors, asset classes, liquidity conditions, and all those other potential sources of risk?
Because what you don't want is a bunch of managers who are all making the same bets at the same time.
Right. You want to avoid those unintended concentrations of risk and those synchronized drawdowns. And the paper really highlights the value of favoring managers whose returns are driven by idiosyncratic risks that are specific to their unique strategies rather than broad market factors. It's about building a portfolio that's truly diversified at its core.
And it's about understanding that risk management is an ongoing process, not a one-time event.
Exactly. So we've covered a lot of ground today. What would you say are the biggest takeaways from this exploration of hedge fund allocation?
I think for me, the biggest takeaway is that it's not as simple as it might seem on the surface. You can't just pick a few well-known hedge fund strategies and call it a day.
Absolutely. It requires a much more nuanced approach. You have to blend those top-down portfolio objectives with a rigorous bottom-up manager selection process.
And that aha moment for me was this shift from those broad strategy classifications to really understanding the underlying attributes of a hedge fund. Its correlation, its resilience in those downturns, its alpha-generating potential.
That's a powerful shift in perspective. And the paper does a great job of laying out that framework with those 4 role-based subgroups. Whether you're building a standalone hedge fund portfolio or you're integrating hedge funds into a broader strategy, understanding those roles, loss mitigation, equity diversifier, equity complement, and equity substitute is key to achieving your goals.
So listeners, here's something to think about. How can this role-based approach to hedge funds influence how you think about diversification in other parts of your portfolio? Could you apply a similar framework to your other investments?
A great question to consider, because at the end of the day, it's all about being intentional with your investments, understanding not just what you're investing in, but why.
Couldn't have said it better myself. Thanks for another great deep dive, and as always, thanks to all of our listeners for joining us. We'll see you next time.
See you then.